Alibaba continues to crash down 41% just over the last year, but this is one that I will be buying. In today's episode, we're going to take a look at the bullish scenario as well as the bearish scenario. We're going to take a look and see exactly what is going on with this company, why it continues to fall, and we're going to take a look and see, for those that believe it is a buy, explain why, and as well why it looks to also be a sell, and consider both scenarios and see what is the best outcome. Now, we're also going to take a look at the historical performance. We're also going to run it through our valuation model. We want to get to the updated intrinsic value as well as our acceptable buy price given our investor margin of safety, and we'll see what Wall Street are forecasting over the next 12 months. And we're also going to take a look at the exact metrics, take a look at the dividend, and talk about how this company is looking very strong over the next few years. We'll also take a look at insider trading, and while there are no buys and sells, we're going to talk about the potential sales of a lot of shares which will impact Alibaba moving forwards. And we'll just touch upon the institutions in the latest Q4, what they have been doing. So let's start from the beginning. Now, it is down nearly 42% over the last year. It is getting absolutely plummeted. Now, the 52-week low is pretty much right around today's price, $67. Today, looking around $68. It does offer a yield of 1.44% looking at the trailing 12 months and a very low forward P at below 8. Now, everyone will know that if this is one you have been holding over the last 10 years, you would be down on your position. And in fact, we see its all-time high towards the end of 2020 at over $300. That is significantly higher than the current trading price. Now, in terms of their top line, and one of the things that we do really like about this company is their growth for their revenue. Now, typically on the channel, 3 to 7% is the minimum baseline we look for. 56 billion on the top line in 2019, 126 billion in their latest annual accounts, March 2023. So they have more than doubled their top line. On top of that, what we can see is consistent growth year on year, although we do know a slowdown in 2022 to 2023 where it did drop, and we'll discuss that when looking at the last 10 years percentage-wise. But nonetheless, over the longer term, it is moving in the right direction. Now, in terms of the bottom line as well, a similar story. We do see 13 billion in March 2019. It did increase all the way up to 2021 before decreasing in 2022 and then increasing again. So the bottom line, in fact, is a lot more inconsistent than the top line. Whilst the top line has been increasing significantly, more than 2 times over the 5 years, we do see their bottom line, in fact, decrease from 13 billion to 10.6 billion. So something to consider there, and we can touch upon that shortly. In terms of the balance sheet, well, they have a phenomenal balance sheet. One of the reasons we do quite like Alibaba, 30.3 billion cash in 2019, 79 billion in their latest quarterly report. So they've more than doubled their cash position, and it is a very, very large amount. Now, when we compare that to Alibaba's total debt, what we can see numerically and directionally, yes, it has increased from 20 billion to 27 billion, but that is very minimal when you do compare it to their cash. And when we do touch upon that net debt to EBITDA metric, we'll be able to see that it won't even take Alibaba one day to pay off all of their debt net of cash on hand. So there is a lot to love there. In terms of their performance over the last year, now this is just against some of those in the broadline retail industry. We have some companies in China as well as in other countries, PDD Holdings as well as Mercado Libre. Now we can see it should come as no surprise that this is total return including those dividends reinvested. Alibaba is one of the worst performing, down 41%, and over the last 5 years down 54%. So yes, they haven't been that great in terms of a total return over the last 5 years or even the last 10 years, but do remember we are looking forwards and we never rely on past performance as an indicator for the future. So this could possibly be either at the bottom or near the bottom for this company, and we're going to discuss why we do quite like this and a lot of catalysts over the future periods. In terms of institutional ownership, well, it is 14.2% as we can see here. 5.7 billion worth of sales over the last 12 months, 9.3 of buys over the same period. But in their most latest quarter, we do in fact see more selling by the institutions than buying, 87 million versus 20 million. But overall, over the last 12 months, More buying, nearly twice as much buying by these institutions than selling. Again, something just to consider. It isn't something you should base your own investment decisions on. Now, a new thing that we have brought into our analysis is looking at insider buying, insider selling. Now, we can see there is absolutely zero buys or sells, in fact, over the last year. Now, the reason we do this is just to see if there is any insider buying, because insider buying is a bullish case. Management typically buy shares of their own company because they see that in the future they believe the share price will go up. Insider selling, now it's not necessarily a bearish scenario for the company. Insiders do this for many reasons, personal and financial. One thing I did want to point out with this, now while we see no insider selling, it is something we have covered on the channel before. Jack Ma plans to sell a majority of his shares of Alibaba. We can see around 10 million in fact, which at the point of this article, which was at the back end of last year, was around 870 million. Now we're talking around 680 million. Now the reason for this, when we did read through this article, the share price is just dropping continually, as we have covered many times, and therefore he doesn't want to sell at what he considers to be a low price. But at some point in the future, we have to believe that he will be looking to sell, given that he had inquired about this in the November 2023 period. Now, in terms of the metrics, before we jump into the bullish and bearish scenario, 174 billion mega cap company. Now, we don't have a dividend safety score just yet because they've only recently started to pay a dividend. And what we can see when we take a look at that free cash flow payout, remember, ignore earnings, it is susceptible to manipulation by management through accounting. We like to see below 60%. Now, what this shows to me, their free cash flow payout is extremely low at 11%. 2024 expected the same. I would like to see double-digit increase to the dividend this year because this is incredibly low. Free cash flow per share, you know I love looking at this. I want to see consistent growth, which is what we saw up to 2021. Now, it did drop in 2022 as we did see that bottom line net income as well fall. But what's nice to see, it has rebounded in 2023, and 2024 is expected to be slightly higher. So it is moving in the right direction over the last 10 years, which is very positive to note, and hopefully we get to see some consistent increases from 2024 and beyond. Now, one area that I have flagged and one area that we'll discuss shortly is the fact that this has been such an incredible company. It has grown their top line double digits every single year. 2023, unfortunately, it dropped down to 2%. Now, two ways to look at this. One, it could be that essentially their revenue is slowing down. The growth has seen over 50% for many of the last 10 years. 2023 now only 2%. It could be a case of their top line coming down and essentially settling around the single digits, or it could be a one-off and we could see it rebound back up to the strong numbers that we saw. It really does depend on how you see the economy, and we'll talk about that Chinese economy shortly as well. So numerically, 53 billion in 2014, 869 billion reported in 2023. Absolutely phenomenal. One thing that I don't quite like is the fact that they're issuing shares, so they are diluting your position as a shareholder from 2.33 billion to 2.64. I would like to see the opposite, especially now. I would like to see a lot of share buybacks given how cheap these shares are based on the information that we have. That forward PE is extremely low. Now, ROIC, as always, this is one that I like to see at 10% or more because it gives me faith management are able to effectively allocate their capital. It has pretty much consistently been around 8 to 9% over the last 5 years. Again, it isn't what I like to see, but I would like to see it come up to around 10%. This is really the bare minimum that I would like to see for any company that I want to invest in. Operating margin and free cash flow margin, very similar to what I said about sales. I want to see this as a case where it does rebound back up to the very strong numbers we saw early on in the last 10 years, as well as the free cash flow margin. Nevertheless, it isn't too bad at 12%. That is probably the absolute minimum I'd want to see. And the free cash flow margin, a slightly better story there at 19%. So this is something that I would keep an eye on, both operating margin and their sales growth over the next few years. And this is what I was trying to get at earlier. The net debt to EBITDA, it shows us two things. The strength of the balance sheet as well as the dividend safety. This wouldn't even take Alibaba one day to pay off all of their debt net of cash on hand. So there are a lot of positive metrics. Now, before we do jump into the valuation model, let's take a look at some of the information and see whether or not there is a bullish or bearish scenario. So this is an article that was done around a week ago. Now it talks about the three different types: a buy, sell, and a hold. So let's just run through it. Now, firstly, one of the reasons they are saying that there is a bullish scenario is that their company's revenue growth is starting to accelerate. Now, remember, I did just touch upon that earlier when we were talking about the top line. Their revenue rose 9% in their most recent quarter, and what is great to see is that their margins are expanding. Their operating margin jumped up 34%. And as we can see here, revenue growth shows that Alibaba is still growing in a weak Chinese economy, and we'll touch upon that in a minute. So when we take a look at another bullish case, the stock is also cheap based on their historical comparisons, and Alibaba is still generating substantial profits. Now, we did touch upon that. They were gaining in terms of a net income. It was looking very strong, but it wasn't growing. In fact, over the last 5 years, their net income had decreased. And the other thing they mention here is their price to earnings ratio of less than 10. As we can see, it is currently around 7.69. Now, if this continues and their growth continues, then this will be absolutely incredibly cheap. And they also believe there is room for the stock to grow if investors reassess China and the discount that is applied to most of the Chinese stocks. The final thing just to note here is that the investors are hoping for the spin-off of their business outside of their e-commerce operation. Now, we can see it hasn't been taken over yet, there hasn't been agreed, but hopefully if that does go through, then investors can see some extra value from that. So there are a lot of positives. Some of these we have discussed already. Now, moving on to why essentially Alibaba should be a sell or why you shouldn't look to buy it, we can just very quickly run through. Now, the biggest one is that uncertainty around the Chinese economy, the regulatory environment, and these are very big risks to consider, and we'll touch upon the risk to reward ratio shortly as well. And in terms of essentially the economy, the Beijing, what they don't want is to have lots of Chinese tech giants who have become too powerful, and if they do believe this to be the case, then they will step in, and this will harm Alibaba in the future. In terms of the economic data, China does remain weak. Now, we did discuss this earlier on about why Alibaba was falling last week. Now, it was the Chinese report economy. It did come down that the economy was in fact shrinking. But one of the things, in fact, it said it grew by around 5.2%, which was surprising because it shrinked. And the reason was because we can see here, China has been known to manipulate, one, the timing of economic data, as well as the actual data itself, according to these articles. So that is one topic for concern in terms of the economy and the validity of this information. And another thing is that the World Bank expects China's GDP to slow in 2024, which will therefore affect Alibaba and their top line. So something just to continue to think about, and we can see here Alibaba's weak growth in their recent quarters. So the one final thing just to discuss here as well is whether or not this company is a hold. One thing that I wanted to point out from this article was that they have a new CEO, as we can see here, Eddie Wu. So they have a new management team as well. So that is something just to consider whether to buy or to sell. It is just something that can be in the discussion. So let's jump into the valuation now based on this latest data that we have. And as always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. And lastly, just to point out that we have recently released the first weekly newsletter just yesterday. If you do want to gain access, it's completely free. Just click on that pinned comment below. We are looking to do a weekly newsletter with a lot of information. Yesterday's information was on the 7 golden dividend metrics, which we run through. Next week, we are looking to discuss some undervalued companies on the watch list and some deep dives. So let's get on with the valuation. Now, the first model is Graham's valuation. We have the stock ticker symbol, the growth rate, as well as the average yield on AAA corporate bonds and the current yield. We get an intrinsic value of $108. Now, the market value, given it's $68, we have our first undervaluation signal. But do keep in mind that we're not looking at any of these models in isolation, and we'll draw our conclusions towards the end. We then have the multiples valuation model. We have the PEs of each company, the average PE, giving a multiples valuation for Alibaba of $119. Again, another undervaluation signal. Now, given the fact they've only recently started doing dividends, we won't use this model. We'll give it a few years to get some consistency, so it isn't relevant in my opinion for today's episode. We then have the free cash flows, which as we can see, forward looking, we have gone very, very conservative at 1% below analyst estimates. With our discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, divide by the shares outstanding, and we get an intrinsic value significantly higher than the market value for that third and final sign of undervaluation. Now, in terms of the intrinsic value, it is purely just the average of these three models. And if you want to grab a copy of this model to get to the intrinsic value and acceptable buy price of companies in your own portfolio or those on your watch list, grab a copy of the model in the comments below. Margin of safety, then, we always start off with 10% if we believe it has a wide moat, strong financial metrics, good forward-looking data. Now, I'm just going to jump straight to it. Right now, the margin of safety that we believe for Alibaba is sitting at around 50%, in fact, slightly higher. We see around 50% up to $74. Now, you have to bear in mind this margin of safety really depends on what you as an investor believe, whether or not you believe that this is a growing company still. You can put towards or one side the Chinese economy or the Chinese data, which could be manipulated, and just China stepping into these really big tech companies and breaking them away. But as always, 50% in my personal opinion for a margin of safety of Alibaba, given this trading at a significantly low P as well, looks like a fairly good risk to reward. In terms of what Wall Street are forecasting over the next 12 months, well, they see upside of 75% with a price target of $120. Now, for me personally, this isn't going to take up a massive part of the portfolio, around 2 to 3%, but it really does come down to your own individual investment thesis for Alibaba. And when you consider Alibaba, you also need to consider China, the economy, the government, the regulatory environment. As always, though, do let me know your thoughts in the comments below. Have you been adding Alibaba today or even last week? If you enjoyed the video, smash that like button, hit the subscribe and bell button, and as always, we'll catch you on the next one. Take care.